Hello everyone, welcome to my YouTube channel. I know we don't have a name to call me by, but you can just call me Zatoichi. So today we're going to just get right into it. We're going to talk about distribution, but I'm also going to take this advantage to talk about external and then internal range liquidity. So when we're dealing with liquidity, one thing we have to understand is liquidity forms in a lot of ways in the market, but what I'm going to be talking about today is internal and then external range liquidity, and then I'm also going to talk about distribution. So all the time before a major sell-off in the markets, before price decides to rally to the downside, you always see moves like this. Something that happens like this all the time to stop out traders. You could literally see that this whole push is not giving anything definitive. It gives a push down, a push up, a push down, a push up, and no solid direction. So all it just keeps doing is you place a buy, it kicks you out, you place a sell, it kicks you out, you place this, it kicks you out. That's the scheme of Wykoff. So it's a Wykoff schematic, and on the upside, before a move comes down or before price starts rallying to the downside, we're going to call that distribution, and then on the flip side is going to be called accumulation. So today's video, I think I resonate more with distribution than accumulation, so I decided to teach distribution first, and once you see it, you can't unsee it. So in the next video where we talk about accumulation, you're going to see it very clearly. So that's it with the schematic. I have a couple of examples that I want you guys to look at, and we'll get into all the technicalities. For now, I just want you to picture this in your head, like just keep this whole, see these lines and just keep a back picture in your head, and if you see it happening more than once or twice or thrice, and when you yourself go into your charts to go and back test, you can tell me if it's random or not. So that's it, and we're going to talk about now internal and external range liquidity. So for those of you who trade with structure, anytime price is in an uptrend and then we keep forming consecutive higher lows and lower highs like this, in as much as it's not always this clean, we can have it something of this sort. Price traces back into a premium area and then goes to the upside. We're going to talk about internal and external range liquidity this way. So anytime price keeps forming these consecutive higher lows, everything on the outside is going to be external range liquidity. So all these higher lows, higher low, higher low, higher low. I'm not going to count this because I literally just put it there so I could show you sometimes that price does not always respect structure, as you guys know it, because price has a delivery pattern it has to follow. So these are going to be your structural patterns, your higher lows. I'll take this off. So this is going to be external liquidity. Everything you see outside is going to be external range. So at the time where the true, for those of you who trade structure once again, but at the time where market decides to reverse, or where market decides to actually break structure, which I do not like to call, I like to call it when market decides to change direction, or when market decides to break structure, as most of you know it. All this range is going to become internal range liquidity. So let's go over it again. This is external range liquidity once price keeps forming consistent higher lows and higher highs. Those your higher lows, which are on the outside of the charts, are going to become external range liquidity. But once, this is the most previous external liquidity, yes, once this area gets traded below, it means that technically we have to fill all these liquidity voids that are created by external range liquidity. So each one of these points has to be cleared. 1, 2, 3, 4, 5, 6. and as many as there could be, but I'm going to show you on the charts. You see that this happens every single time. Price is fractal, so if I show you something on the 4 or the weekly or the daily or the higher time frame, which I don't use that much, it's going to happen on every single time frame. So that's what I want you to get. I want you to have an open mind to all of this, and then watch it happen on the charts. Don't just say, oh, these I've seen this somewhere before, doesn't work, doesn't do this. I want you to have a very open mind, watch it happen on the charts, prove yourself right, prove me wrong. If you can't, then you just see that these things happen, and then we can learn forward. So this is it with external range liquidity. I know it's a bit choppy with the explanation and the diagram, but you'll see it on the charts. Let me just leave it here so we can come back. So I'm going to have certain price points or certain chart points in the market that I want you to take specific looks at. So I want you to look at this point, this whole range, or for those of you who do not trade consolidation markets, consolidation is choppy, do not stay away from consolidation. Anybody who's telling you to stay away from consolidation markets don't know what they're doing. So a consolidation market should be your best friend if you understand what consolidation is doing. And it's not just only Wykoff, there's a lot of ways, but one of the simplest explanations that someone has come across, Wykoff is not my work to take credit of, it's a schematic that is named after Wykoff. So this is a distribution schematic, so I want you to look at this, and then right from here we see how price decided to fall off from this point all the way down here. And then just I want you to look at it, keep like a mental image in your head of how the structure looks like over here, how market patterns look right here. Look over here, do you see the same thing? Okay, even if you don't, you just keep a picture, because right after here you saw our price did a rally to the downside, and also here. So just keep these three images in your head. We're going to switch to a part of the charts where I can actually show you with the names and whatever happens in each of the stages that I'm going to denote for Wykoff. It's going to be very different from many indicators. It could also be similar because the structure of Wykoff is open to interpretation, but the stages for almost everyone are going to be the same. So let's just go to okay, so right here, let's do this. Look at all the stages of Wykoff distribution. Firstly, we have the preliminary supply, we have the bias climax, we have the uptrust, we have an uptrust at the distribution. This SOW here signifies sign of weakness, LPS signifies last point of supply, MSOW is literally a major sign of weakness. It's the sign of weakness happening, but it's happening again to confirm to you that price is actually going for lower prices and preparing to melt down to the downside. So, and then here is also another last point of supply. So before we look at this, I'm pretty sure but I'm pretty sure that distribution always happens after price takes out a major liquidity point in the market, or a major psychological level, the prices where price usually reacts to. And when you're looking at forex pairs, you would want to be taking these in increments of 250 and 500 pips. So literally at every 250 and 500 pips, I'm not saying it's an automatic thing, but that's where the psychological levels of most traders are. So at that point, most traders feel like price is going to switch or price is going to reverse. Those are major psychological levels for traders. And just before every psychological level, there's important liquidity to the left side of the charts that has to be taken out. So because literally around that area, somebody has an imbalance candle that they want to sell off of, somebody has whatever structure it is, somebody has their sell stops or buy stops resting around that area, and then price has to clear all that liquidity before it decides to do a meltdown. Okay, so let's move to the left side of the charts. And so this is a major structural high, because right after this cleared all this the noise to this side, this trend line liquidity, as I'm going to say. You're going to see it when I explain it in terms of internal and external range. And then we also had this high to this point. So these are the two major liquidity points for now in this market. So right here, and also this type of a candle around this point, we have our other blocks here. This is also going to be a supply candle. I'm going to get into the details of it later in subsequent videos, very subsequent, because once you understand true supply and true demand, not always as order blocks or however it's denoted in many teachings, when you understand what candles actually are supply and what candles actually are demand, it's very easy to see. So right here, this was our major liquidity point in the market, because if you're going to go off of other retail trading concepts, we're all trading retail though, but if you're going to go off of other retail trading concept that says that over here, if you're in a sell, you have to place your stop loss right above the swing high. So let's say if we want to sell, this is going to be a area for a stop loss. So let me extend price to the right. And then yeah, so that brings me, oh, even perfect, that brings me to this part of the scheme. So now let's discuss it. Preliminary supply is the first indication that price is going to melt down, but price is not ready yet. So anytime price forms preliminary supply, price is going to, it's literally showing exhaustion of buyers, you get. So if we're going to notice, price is going to be in a very steep uptrend, but from here price keeps perfect. Let's discuss external range liquidity. So right from here, when we broke these short-term lows, all price kept doing was forming this higher low, higher low, higher low, after higher low, higher low, higher low, the same thing all over again, higher low, and then higher. So this very first break over here is major indication that we're going for lower prices. But then what was price doing? Price wanted to clear all this liquidity. So just take this from me, which is not financial advice, as I'd say. Once price is in a very steep downtrend or a very steep uptrend, all price is doing at that point is creating external range liquidity. So right here, let me denote external range liquidity always in yellow, and then once it gets broken, it's going to be is going to be internal range liquidity. So right here, when price was in this downtrend and kept forming these consistent lower highs, here, here, and here again. So all price kept doing was forming consistent lower highs. All that was going to be external range liquidity. That is drawn liquidity for price if price keeps going to the downside. But now, this was our most recent low in this whole push to the downside. And once that got broken, it means we are prepared for upward pricing. That's price pushing to the upside. And for price pushing to the upside, price has to clear all this steep movement, because it moved so fast, so steep, it's all liquidity. Price has to clear it. So once we break this short-term highs, let's go, let me show you this. Once you break these short-term highs, everything inside here becomes internal range liquidity, because now price is moving to the upside. All this becomes internal. So now I'm going to denote internal range by blue. So now all this liquidity, once we break this point, we did it with this price leg. So once we break this point, every part of this liquidity has to get filled. So for those who are asking, how do I know if price is in an uptrend? How do I know if I'm going to respect my points? How do I know if price is going to respect structure or whatever it is? Just go off of internal range and then external range liquidity. Okay? Because if there's a steep movement to the downside, price has to be balanced, of course. So once we clear out the most recent lows in the market or highs, that's depending on the market direction, once we clear out the most recent lows in this case, because this was a downtrend, it means price is going for all these prices, and then we have to clear it before a major move. And once we clear it, we're looking for accumulation or distribution. If we're in the upside, we're looking for distribution. If it's to the downside, we're looking for accumulation. So that's it for internal and external range. I hope it was a bit clear. I hope it was actually clear. So now let's go to distribution. So the first stage in distribution is preliminary supply. So that's where the sellers plant their foot. So once the sellers planted their foot, we saw this liquidity get taken. But then we're not ready for the move yet, because if you're going off of external and internal range, we know that all this internal range, which was once external range, now has to be filled before a move to the downside can happen. So yeah, let me delete these so when we come back. So now this is our preliminary supply, and then after the preliminary supply, price is going to take out the preliminary supply, and then we're going to have a buying climax. This is officially where the buys are done. So at the buying climax, it literally means that buyers are exhausted in the market. That shows an exhaustion of buyers in this particular market. So once there's the buying climax, the next phase we're going to have is the uptrust. So the uptrust is always going to print into the liquidity point. 90% or 80% of the time, to pick 90, it's always going to print into our liquidity point. Why? Because pure psychology. All it's just doing is once you've printed it to this level, whoever is in shorts from here is going to have about 1.2236 to they've had about 50, 60, 70 pips of profit. You get? The trades are open. They have their stop losses right here. And one thing about these markets, do not marry your trades. Do not marry your trades, because price is always going to come for your stop loss. If you're marrying your trades and if you don't know what you're doing, price is coming for your stop loss. So right here, whoever is not in the know of Wykoff schematic at an important liquidity point or at a major psychological level is going to be in trouble, because the person's stop loss is literally there. They're like sitting ducks in the market. They're waiting to be hunted. So that's it for this point. So that's what the uptrust does. The uptrust prints into the liquidity point, gives a couple of pips. Traders are happy, they sleep, wake up, have the stop losses blown, and they don't understand what happens, and then price moves in the direction. So right here, we're going to have the uptrust after distribution. So the important part of the uptrust after distribution, this is what confirms Wykoff schematic. An uptrust after distribution confirms a Wykoff schematic for sales. So the uptrust after distribution is going to take out that major liquidity to the left side of the market. So let's see, I marked this with the top of that line. So yeah, we can see clearly how price printed above the liquidity point and then also above the uptrust. So an uptrust after distribution is your very first signal that your Wykoff schematic is actually going to, has a 90% probability, more than 50% probability of coming into play. Okay, so now we're looking for signs of weakness. So at the uptrust and the uptrust after distribution, we saw clearly relatively equal lows at this point. So with these relatively equal lows, this is the relatively equal low that we're expecting price to take out. Because if somebody might also argue that there are relatively equal highs here at the uptrust after distribution, yeah, they are relatively equal highs, but why didn't price take them out? Because we're done taking out the liquidity to the left and we're getting ready for sales. So if you're in the know of what you're doing, these are the relatively equal lows you want to take out, because you've already started seeing your schematic form. I want you to see it with hindsight, and then anytime you go on the charts, you're going to see it. If whether on the 1 minute, whether on the 2, on the 3, any custom time frame you want is going to be there. So right here we've had our preliminary supply, we've had our buying climax, we've had our uptrust after distribution. So after our uptrust after distribution, once price takes out this sign of weakness, once price takes out this relatively equal lows, this is a sign of weakness. This is showing us that price is preparing to go for the downside. So a sign of weakness literally shows that price is preparing to melt. On the flip side, a sign of strength shows that price is preparing for a buy. So in this case, we're looking for sales. So it means that there's weak pricing over here. From the UTAD to the sign of weakness, that shows that price is weak in terms of pricing. So in this case, all we're going to do is I'm going to teach you how to get the entry from the uptrust, because right after your uptrust you can start looking for ways to enter the market, and also after your major sign of weakness you can also look for ways to enter the markets. So from our uptrust after distribution, I like to use the Fib tool, the Fibonacci tool, but it's all hindsight. I don't use the tool, but if I'm teaching, it's that easy. Just use the tool and then you see it. So with the more you use the tool, you begin to see things in hindsight. So as you've learned, the premium areas are above the 50% area, and then discount areas are below the 50% area if you draw the Fibonacci for a trading range. But I'm going to show you that there are deep discount and then deep premium areas in the market. If you're going to use just the 50 area, you're going to have a very wide stop loss, and I don't think that's beneficial for any account. So right from our uptrust after distribution, we're going to draw our Fib to the sign of weakness. So let me just leave on the 79 level for now. Fibonacci levels are very different. Each percentile has a role to play So for now, I'm going to leave the 79 in terms of distribution. And usually for accumulation, when we're looking for our last point of support, we usually use the 38.2, but we get to accumulation and then you see that either the 38.2 or then the 62, but mostly the 38.2 when it comes to the last point of support for accumulation. But for distribution, the 79 is going to be your best friend. So let's just say you entered this trade on the 79 level. Your stops are going to be above the uptrust of the distribution. And let's just say you targeted beneath the sign of weakness, or you decide to target this fair value gap right here. I'm going to teach you targets in subsequent videos, so how to target and how to. I'm more of an intraday type of trader, but when I was learning how to swing, I went off most of these concepts. So this would have been an almost 1 to 5 setup. So for the uptrust, from the uptrust after distribution to your sign of weakness, you like to draw your fib from the high point to the low point of that structure. So that's going to be one way to get your entry. And let's say you missed the move, so now you're going to look for an entry from your last point of supply to the major sign of weakness, where price actually continued to break this structure, where price was continuing structure to the downside. So all we're going to have is from the beginning to the end of this move. And then you literally have price at your 79 area. For those who could say, let's say price did not hit my fib, level, you like to get the move from where the push actually started. The push did not start from the last point of supply. This is the wick. If you want to get, you'd like to get from the body, but I personally would draw it this way and I know what I'm looking for. But if you're going to be drawing your fibs as a beginner, always do it from body to body. Okay, so body to body, and then there are areas in the market where you would like to do a wick to wick or a body to wick. Wick to wick, very rare, but body to wicks, you do it at the DXY opening and in volatile markets like just at the beginning of landing, which is 8 to 9. So for now, let's just do body to body to keep it basic. So this is our body, this is the body of where the push ended. So yeah, this is going to be our 79 level. Once again, stops right above here. And then if we're targeting, we could have targeted beneath this major liquidity, or if I'll come to rebuff my point about external and internal range liquidity right here, but this is how you get your entries for the last point of supply on Wykoff's schematic. So with this, if you're on the 4 hour or whichever time frame you draw it on, I like to get these type of entries on the 15 minute. On the 15 minute, once you have 3 wicks of rejection, 1, 2, 3 at your 79 level, you're good to go on the 15 minute. I and the person who educated me like to call it a tweet up. So that's a tweet up formation. That's how I was taught, and that's how I'm teaching you guys. So the tweet up formation on the 15 minute. Once you get that on your last point of supply or wherever you've drawn structure from, that is a very good confirmation that price is ready to melt. So now let's go and see where this price is actually going to end, or where the sell-off is actually going to stop. So right here we said we had price, once we blew above this area, anything will be forming right in this zone is going to be external range liquidity. So external liquidity, let me just change this color back to yellow. External liquidity here, external liquidity here, external range liquidity, external range, external range, external range, external range, external range, external range again. So let's see, let's test that theory and see if price is actually going to come all the way down and clear out our external range liquidity. So yeah, so we've had our shorts from our last point of supply. If I don't know, whoever wants to hold up this trade for 1,000 pips, or if you've not closed up, right here, perfect. So price took out the bottom of this this area, the external range liquidity at this point, and then now prepared to clear this most previous internal range liquidity. Just right here, this is going to be a homework. So literally, price, we had a steep movement, downside, 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 downside. So once we broke these short-term lows, price had to come and then fill all these points before we could reverse. So it's very fractal, happens all the time. Any single time frame you want to test this on, you're going to see it. And I'd like you guys to go over distribution, markup on your charts. I'm going to leave my Telegram in the description of the video. You can send it to me if you make any markup and then you feel like maybe this is a bit confusing to you. You can always hit me up on Telegram. If I'm free, I'm going to reply. If I'm not, please wait patiently. I also have things to do. And so thank you very much for watching this video. If you like it, you can always leave a like and then subscribe to this channel for more content.